Hi, everyone. It's so nice to see you. My name is Erica Diagnan. I am founder and managing partner at 1000 Angels. And I want to thank you for joining our Intro to Startup Investing webinar today. I'll be going through some really interesting foundational elements of getting involved as a startup investor, as well as answering any of your questions about how we evaluate investments, some of the things that we think about before making investments, as well as some of the elements of developing your own portfolio of early stage investments today. And I'll also be here to answer any of your questions that you have about membership, angel investing, deals we've done, or anything like that. So if you're interested in, asking questions, there's definitely a couple functions here within the webinar. You can use our Q&A box. You can use the chat communication window. And you could also, if you feel like talking to the group, just raise your hand and I'll unmute you and you'll be able to ask your question verbally. So thanks for joining and let's get started. So I will be sharing my screen so that you should be able to follow along with our presentation. So given that this is the first in our cycle of the course, today we're really just going to be going over the basics. And definitely, all questions here are good. Any questions that you have, feel free to jump in. Definitely, we welcome them. And hold on a second. We will just talk a little bit about myself. So I'll be your coach today. And sorry, I don't know why this isn't doing the full page. Hang on one second. There we go. Single page. That's better. Now you can see the entire slide. So a little bit about me and my background. I'm founder and managing partner at 1000 Angels. I've been investing for well over a decade and got my start as executive director of Golden Seeds, also as a managing director at DreamIt Ventures for several years, which is one of the top tech accelerators. Prior to that, worked in investment banking for about 8 years and did my MBA at Columbia Business School in finance, as well as undergrad degree in econ from UCLA. And I also happen to now teach this course for Columbia Business School's executive education program. So if you guys are interested in actually, taking that at Columbia, that's also an option as well. We actually do the course specifically with a focus on instruction for professional athletes, so NFL and NBA players. But of course, 1000 Angel members are also permitted to take the course. So if that's something you're interested in, you can email me directly about that. So a little bit about what we'll be going over today. And we're probably not going to get through this entire session today, since today we have about a half hour, and usually this takes more like an hour and a half. So we'll get through part of it and then do the next part in a few weeks. But we'll be talking a little bit about what is venture investing, what are some of the risks and rewards of venture investing, as well as why we need to use a portfolio approach in order to start making these investments, what makes a deal investable, and how we look at the actual process of making investments. So really starting at the beginning, what is venture investing? And if we look at the definition of an angel investor is an individual who makes a direct investment out of personal funds into a venture, typically an early stage business, right? So a company usually that may be pre-revenue, but is usually not yet cash flow break even. And because these angel investors are coming in, investing their own money at a relatively risky time in the venture, it's really important that all angels are what we call SEC accredited investors. So a lot of people hear the word accredited investor and they get a little nervous thinking that it means that they need to have passed some examination or gotten some sort of a certificate from the SEC. But actually, it just means that you meet their standard of being a high net worth individual. So you don't necessarily need to file anything with them. But when you start making investments in this asset class, you need to typically verify to the companies that you meet the standards of being accredited, which is that you've either earned more than $200,000 in annual income, at least 2 out of the last 3 years, or that you have net worth excluding your primary residence of at least $1 million. So the reason that they have they came up with these rules back in 1933, and there's a lot of sort of argument about whether or not this makes sense. But basically, they just want to make sure that anyone who's investing in relatively risky or illiquid securities, meaning that you can't easily convert them into cash, has the financial wherewithal to be able to, hold on to the investment for the long period of time that it takes the investment to come to maturity, where you might actually get a return. Or, if it ends up being a total loss, that you could withstand that loss and it wouldn't necessarily break you. And, this is very much why we focus on educating our members about why taking a portfolio approach is so important within this asset class. We'll talk a little bit more about that as we get to portfolio. So the different types of early stage investors that are out there, you've probably heard a lot about, venture capital firms. You've probably heard about seed funds. You've probably heard about, friends and family rounds. So if we look at this chart, it kind of gives you a sense of where 1000 Angels sort of plays within this ecosystem, and why membership in 1000 Angels can be beneficial to individuals who would like to start building a portfolio. So if we look at some of the vehicles that you're probably maybe familiar with investing through, we first start off with friends and family rounds. So usually when a company is the very first time they're raising money, they do what we would call a friends and family round. And this is typically for anything less than, say, $250,000 being raised. The CEO and the management team will usually go out to people that they know and get their first infusion of capital there. So we call that friends and family. Usually the deal terms are not well negotiated because it's typical that friends and family don't know how to negotiate deal terms, and probably the founder doesn't really have a great sense of what the deal terms should be either. So those people will either come in for common stock, or they'll come in maybe with some sort of a convertible note. But these are sort of rounds that aren't really professionally managed, and so they're really more about people in the founder's ecosystem showing that, hey, I really believe in you. So it's your Uncle Joey, it's your grandma, it's your parents, it's the guys and girls maybe from business school who think you've got a really great idea, are typically the people coming into this round. And if for most people, they're going to get some of the money there. And if, they don't quite, maybe they were able to raise $100,000 or $150,000 through that vehicle, but they still need a little bit more. At this point, they may have an opportunity to reach out to some local investment clubs or local angel groups. So a lot of the local angel groups that you'll find, particularly out of, big metropolitan areas, like probably not necessarily in San Francisco or New York, but if you look at places in the Midwest, in the Southeast, a lot of in Texas, a lot of these regions have local investment clubs or angel groups that are actually really focused on making investments in early stage companies because they think that it'll actually help to stimulate the local economy. So they similarly, might be sort of helping to add a little bit more in total capital raised to a startup, and they might also be helping them take a little bit more of a professional approach to the deal terms of the round. But similarly, they also tend to have a little bit of a less, 100% financially motivated reason for investing in the company. They probably want to see, people in their local area or, young people that they care about start to really evolve businesses in their region. So that's where you'll see some, investment clubs. And then sometimes also super angels, who are people who just, probably have been very successful in business themselves, and they want to give back, and they may just, invest in individual companies on their own. So those are really what you'll see kind of with companies that are raising generally up to 250K, but usually anything below $500,000. So where we kind of play is closer to where you would see traditional seed funds and venture firms. So the difference between a seed fund and a venture firm and, sort of these other two categories of investors that we mentioned before is that funds and venture firms are generally professionally managed capital. So what will happen is that the manager will be somebody who either, has a successful track record in business or has made several successful investments on their own, and they've done so well that they're able to convince other people that we call limited partners to give them money to invest. So these are more professionally managed funds, and the seed stage funds tend to start with companies that are a little bit earlier stage. So usually companies that are raising, minimum of $500,000, up to kind of like $2 million might be considered a seed round. And then the VC firms tend to start a little bit later. So, once you've actually shown some revenue traction, and, typically they'll come in more like when you're raising, say 1.5 million and up is when venture firms come in. So seed funds and venture funds, very similar structure as a business. It's just that, seed funds are focused on coming in very early, and venture funds are usually focused on coming in once the company is raising more than $1 million. But typically, both of these types of funds are not going to invest in rounds of smaller than 500,000. There's actually one additional source of capital that I'll just sort of throw in here, although it's very different, that could be considered an option for companies that are, sort of really just getting started and might be in that friends and family category. And that, of course, is accelerator money. So generally, when you participate in an accelerator, they're going to invest, somewhere, depending on how well capitalized the accelerator is, they're going to invest somewhere between $25,000, up to sometimes $125,000 in your company, typically in exchange for common equity, or sometimes they'll use what we call a safe note. But that's also another option as a source of capital. Most accelerators require some sort of, in-person participation, and they'll also provide you with a lot of other guidance besides just the capital to help your business get off to a great start. So that's another thing that's not necessarily on this list, but certainly is a resource for companies that are raising money. So if there's a company that you're looking at investing in, and they're applying to an accelerator, they've been accepted to an accelerator, you should probably also understand how that is a potential source of capital. So when we talk about the risks and rewards of venture investing, what we're really trying to do is just answer the question, why even bother start venture investing? What's the point of it, right? Because there are some significant risks. Number one, there's a high risk of total loss. Because typically with this type of investing, the companies don't have any assets. They typically don't have a lot of revenue, and they're, usually not cash flow break even. So, there is certainly a risk there. That the investment could be completely lost. And a lot of what they're, spending the money on, what we call the use of proceeds, tends to be things like software development and marketing and, maybe minimal salaries for the initial employees. So, they're not like going out and, buying a tractor that, if the business doesn't work out, they could sell the tractor and give you the money back, right? They're not buying fixed assets. It's all kind of being invested in things that are, what we would call intangibles, that they're hoping to turn into valuable product. The second thing is that there's a general lack of liquidity. So, not 100% of the time, but generally when you start making an investment here, you should expect that you're not going to get any liquidity. Sometimes, if you come in like a seed or Series A round and the company does really well, and there's maybe like a Series C or Series D occasionally there will be an offer of liquidities to some of the early investors. And liquidity just means, can you take your shares and turn them into cash, right? So unfortunately for most of the stuff, even if the company is doing really well, there's not a very clear way to take your shares and turn them into cash. And, it's funny because that's an issue that, people in this space have kind of been working to resolve for a really long time. So, who knows, maybe in the next 5 to 10 years, some really wonderful startup will come, will figure out a way to address the lack of liquidity problem within startup investing. But for now, we don't have a solution. So you need to kind of assume that even if the investment works out the way that you hope it to, the way that you hope it will, there will probably be at least 5 to 10 years from the time of investment to exit. So there's another thing that I want to throw in here too, which is that it's not even just that there's a lack of liquidity and that it's a long investment horizon. It's just that, you don't know when, you have very little control over when you're actually going to get the money back. So, in addition to the fact that, it generally takes a company about 10 years to build, develop, and, get to a point where they might have an exit and be able to provide you with your return of capital plus gains. It also could be a situation where, you make an investment and then, within a year, the company gets acquired and, instead of getting 10x your investment, maybe they're giving you, 2x your investment back, in a year, which is, still great. But, maybe you were thinking, oh, I want to actually have this investment outstanding for the next 10 years because I'm hoping it's going to, fund my kids' college or something like that. So, the point is that even in good situations, you just, there's very little visibility as to when the money is going to come back. It's basically going to come back when they're ready to give it back to you. So with some of these risks and downsides in place, why do we bother doing this, right? So, well, it's because, there are still actually a lot of potential rewards. So number one, if you are very diligent about the way that you build your portfolio, this asset class definitely will provide above market returns. And so typical, what we call internal rate of return for, sort of, I would say kind of where we play, which is, between kind of seed and Series A on a portfolio is typically around 25%. So what you are expecting your internal rate of return to be, sort of over, let's say, a 10-year period with a portfolio of, say, at least 20 companies, maybe more, you're expecting to generate about 25% a year in return. So, one thing that's very important to remember is that the standard deviation of returns is very high, right? So, if we look at, a portfolio of, say, 25 companies at the early stage, you're probably going to see something like, 15, maybe even, not necessarily returning any capital. You're going to see maybe another 5 kind of being break even, and then you're going to see 5 of those providing the majority of the returns. So making sure that you are approaching making these investments, understanding that diversification is really the key to success in this asset class is very important to actually achieving those above market returns. Because if for whatever reason, you took that pool of 25 companies and, you didn't take a diversified approach and, maybe you over the course of 10 years only, concentrated all of your money into 10 companies rather than, over the full 25, there's a much better chance that, all 10 of those kind of end up in either the no return of capital or just getting your money back situation. So by taking diversification seriously, we can maximize the overall expected return. And we're going for 25%. And so, we'll talk more about this number, but, I think that it's a really important thing to, to realize and to think about as we're looking at how we evaluate deal terms, because a typical stock market rate of return is somewhere between like 6 and 8%. So this is significantly higher than that. And so what we need to be very careful of is to understand that the cost of capital for our asset class is very, very high. And so when we start investing in companies, we have to be very careful about valuations, and not, sort of overpay for early stage companies. So usually, with 1,000 Angels, we're pretty strict about that. Typically, when we start with companies in a seed round, we're looking at valuations of kind of $3 to $5 million. And being really conservative with valuations helps us make sure that we meet our overall target portfolio returns. So outside of the financial return aspect, which of course is great if you are, diligent about your investing, and you're not just sort of taking a spray and pray approach, there are quite a few, sort of other benefits to doing early stage investing that attract a lot of people to this activity. So number one is you get to meet really interesting people. So typically we're only investing in the top founders and sort of most high performing startups that are out there. And generally the people that are on those teams are pretty, intelligent, charismatic, just interesting people that you're going to learn a lot from. And as an investor, you basically have an opportunity to, sort of form relationships with, people who are influencing the future, who have great ideas, who are wonderful leaders. So from a perspective of being able to expand and cultivate your own network, it's very, very rewarding. You'll also have an opportunity to learn a lot. So, even in a very simple business, and certainly with 1,000 Angels, we're not trying to be, in the next Theranos or some crazy crypto company or blockchain thing that nobody can understand. We like to invest in things, that we can understand. But at the same time, you will learn a ton by being involved with a startup, because you're basically kind of on the leading edge of developing a new product or market. So just peripherally by being involved, you tend to learn a lot about what's going on with business, what the trends are, what challenges that founder is experiencing. It's kind of like doing a business school case, but in real time, right? And as an investor, you're really there on the inside, seeing what's going on and getting a lot of information that can be inspiring for you in your career or as an entrepreneur. And then lastly, we really just like to have fun. It's exciting to be part of something that's new, and to see, some of these really amazing people who've started businesses succeed and grow their companies into very large, successful organizations that are influencing people's behavior. I mean, there's nothing better than when you've invested in a startup, and then, a year or two later, you see, a bunch of people, using that app or that technology or that product and really loving it and knowing that you were part of actually bringing that into the world. So that's one of the things I think that people really appreciate about this. But for me, I would say that probably, one of the most rewarding things about investing in the early stage is that, you're still in a position where you're very close to kind of what the vision for the business is and what's going on with the founder. So when we're making an investment, we're directly putting that money into the company, and that money is actually being used to execute on the vision, right? Versus when you sort of buy a stock in the stock market, you might think Facebook or Google or Apple is great, but you're really just sort of, trading money with, some other person, right? So, when you purchase those shares, you're not really investing in the growth of the company. You're basically just, paying out somebody else who maybe bought the shares a few years ago at a cheaper price. And it's also, when companies, sort of go public and get very big, there are kind of a lot of veils between, you as an investor and really what's going on with the business. Whereas at the very early stage, you're very close to the ground, and you can really sort of get a sense of what it is you're buying, right? It's like, okay, I know I just bought, 1% of the equity in this company that's doing XYZ. I have an idea of who the founder is. I understand their product, and, here's where they're going. So from that perspective, for me, I feel like, you've sort of eliminated, and of course it can't be your whole portfolio, but for at least part of it, you've eliminated the whole like Wall Street component, and you've really, sort of put your money into creating the future. And that's what I think a lot of people love about early stage investing. So this chart here just shows you a little bit about the risk profile of the various asset classes. So you can sort of get an idea of where we are. We're basically all the way out there on the risk profile. If we look at sort of, treasuries as being lowest or close to zero risk, to money market, corporate bonds, public equities, commercial real estate, then private equity. So just to give you guys a little bit more info. So private equity is essentially a category of what we're doing, but traditional private equity is typically, that nomenclature is typically reserved for the later stage. So when, companies are still private, but by this point, they probably are generating pretty significant cash flows. So, that sort of risk, we're saying that there aren't any like assets on which to sort of base the valuation of the company. The company doesn't have that at this stage. So usually by the time, companies have reached private equity stage, which is kind of like series, C or D, probably closer to D rounds, they've already really established, consistent revenues, and they're probably cash flow positive. Then we go to venture investing. And so what we do at 1,000 Angels is probably, kind of like 50% venture investing, maybe 50% seed stage. In fact, I'd probably say it's a little bit less. Probably we're closer to 25% seed stage. And so with venture investing, this would be generally Series A, Series B. So typically, companies that are raising usually $2 to sort of 20-ish million, $2 million and up, basically at those rounds. And, the companies typically here are not yet cash flow positive, but they already have established revenue traction. So usually before a venture fund gets involved, a company typically needs to be doing at least $100,000 in monthly recurring revenue. So it's like a little bit more than, $1 million in annual revenue, but they also have to show that they have, a very high growth trajectory. And that's, usually at least, 10% month over month. So we're kind of looking at, doubling revenues every year is the expectation before you get venture investment. So some of the deals that you'll see on 1,000 Angels are kind of in this venture category, and then some are in what we call the seed stage category. So seed stage is kind of even before that, where you maybe just have, minimal revenue traction, you've got a product, you've got a proof of concept, you've proven that you have a market, you have some customers, but you're probably not yet kind of over $1 million in annual revenue. And the reason that we get involved here is that when you are an individual making investments, so, maybe you're investing, say, $20,000 per company or $10,000 to $25,000 per company, being able to come in at this round can provide you with what we call like just a very cheap option. So you're essentially getting usually a very low pre-money valuation. So for example, we have a company that's currently raising money on 1,000 Angels that we started with in 2016. So we participated in their seed round in 2016, and it's a robotics company. So even by the time they got to their seed round, they had, already recruited like a team of NASA engineers and, had some pilots in place. They had really like kind of made some traction, but we were able to invest in the company at a $5 million pre-money valuation. So that was kind of end of 2016, I think. And then in 2017, they raised a bit more money, at a $7 million valuation. So just like a very small bump. And then now, they're doing a Series A, but that Series A is probably going to happen more at like a $25 million valuation. So, the difference between valuation in seed and that very next round of Series A is usually kind of like, 5 times more expensive. So that's part of why, we actually look at, making sure that we participate in seed rounds as well. So anyways, that is all we have for today. And I want to thank you guys so much for joining. We'll be continuing on I think, August 27th. But if you head back to our webinar sign up area, you'll be able to sign up for part 2 of Intro to Venture Investing, Risks and Rewards, and we will continue the conversation. If you're interested at all in chatting more about becoming a member of 1,000 Angels, please feel free to reach out to me at any time. My email is Erica, ERICA, at 1000angels.com. And I'm happy to set up a one-on-one demo to talk with you and answer questions. So thanks so much, and I will see you all soon. Bye.